Day trading sucks and it'll make you broke. Long-term investing will make you wealthy. If you're a new investor or someone who finds yourself bouncing back and forth between if they want to day trade or focus on long-term investing, then this video is for you. At some point in everyone's investing journey, they'll wonder if they should focus on long-term investing and learning more about companies' fundamentals, or if short-term investing, such as day trading or swing trading, and focusing on daily charts is better. Without further ado, let's dive into it. So in this video, we're going to focus on a couple of areas. First, we're going to look at the stats for both if you followed long-term investing or short-term trading. What's your chance of being successful at it? Next, we'll look at the baseline. So whichever strategy you pick, you should always be able to at least perform in line or better than what the indexes are doing. Next, we'll look at the considerations for a long-term investor and the considerations for a short-term trader. We'll dive into what the tax implications are for each method. Towards the end, I'll give you some long-term investing tips, and then we'll wrap up with some words of wisdom. So starting off with a short-term trader, looking at the data, what they find is about 75 to 80% of retail traders end up losing money. And one of the main negatives that happens because of this is most retail day traders end up quitting quickly and leaving the market altogether. And if you're a day trader, you have to compete against highly capitalized institutional algorithmic traders. So, institutionals have machines that are trading on the millisecond, millions of different shares, and it's almost impossible to compete with those. Now, if we look at the long-term investing success in the market overall, looking at the S&P 500, if we just look at a 1-year time frame, you can see that 75% of the time it is positive. So it's the inverse of what we just saw for a short-term day trader. You're not likely to lose money, rather 75% chance it'll be positive. And if you extrapolate that over multiple decades, once you get to 20 years plus, you're guaranteed of positive returns. Next, let's dive into the baseline. So, regardless of which method we choose, long-term investing or short-term trading, what's the baseline that we need to make sure that we're beaten? So, looking at the S&P 500 and the Nasdaq 100, these are the two baselines that you want to make sure that you're beating because otherwise, why would you spend the countless hours to do any different strategy other than just buy the index and kind of set it and forget it? So, the S&P 500 anywhere between 11 to 12%, and the Nasdaq 100 14 to 16%. So let's dive into the considerations that you should consider if you're going to be a short term trader or a long term investor. So, starting off with a short term trader, a couple things that you need to consider are you need to consider what are the candlesticks on the chart doing? How are they changing every minute? What's the daily RSI? What's the daily volume? What's the inflation rates? Is energy and gas prices starting to increase? Are there different wars happening in the world? What did the president just say yesterday? What's he going to say today? What is the Fed chair saying? What did the random news lady say on the news this morning or this night? Are there any natural disasters that are happening? Are we entering a recession? What are those pesky machine algorithms doing and what are they going to be triggered by? The whole point of this is that these are things that are not in your control. It's really a gambling mindset because you don't know when any of these are going to trigger the market to go up or down, and it's impossible to predict it. If you're going to be following a gambling mindset like this, you might as well just go to a casino, put your money into a slot machine, and just see if it hits or if it doesn't, because that's basically what you're doing here. And if you're thinking, well, if I'm day trading, that way I can pull my money out when times get bad and I can, just wait until things start to improve and get back in so that way I'm not losing money. Well, there was a study done of if you miss some of the top days in the market, what's the impact to your returns? Over a 20-year time horizon, if you even miss just 10 of the best days of a 7,000 plus duration, you cut your gains in half. And if you just missed 30 of the best days, over those 7,000 plus days that happen in 20 years, you essentially made zero money. So all this, I'm going to get out of the market when times get bad and I'll get back in so that way I avoid the downside. It's not going to happen. And let's look at the 10 best days over that time frame. What you notice is these are all when the worst market conditions were happening. Because when the worst days happening, they often follow by some of the biggest positive days too. So you would have easily missed these days if you were trying to sit it out during market turmoil. Now, on the contrary, let's look at a long-term investor. What do they need to consider? When a long-term investor is looking at individual stocks, they really need to look at what the company does, what they sell, what's their revenue and profitability growth. They need to look at their balance sheet to understand the cash and debt levels, to understand if the market hits temporary turmoil, can they get through it? They need to look at the valuation so they're not buying an overpriced company that's priced in several years of gains already, which is going to kill their returns. And then ultimately, they need to run their future projections so they can be confident about where they see this company going. And then the last one is consistent contributions and buys. And this one, if you're only buying ETFs, not even dabbling in any individual stocks, this is literally the only thing you need to consider. If you're only buying ETFs and holding it for the long term, you don't need to know what a company does, what they sell, what their profitability is, valuations, what's currently happening in the market from a short-term noise perspective. All you need to do is consistently contribute to your account and buy and let the compounding work for you. So, as a long term investor, you really just need to be focused on the business fundamentals and having good time in the market. So, ultimately, it just comes down to the old saying, how it goes, the old KISS acronym: keep it simple, stupid. Why would you focus on all these short term noise indicators that are outside of your control? At that point, you're gambling and you're just throwing your money and hoping it grows. Why would you not focus on things that you could stay in control of? Next, let's dive into tax implications. So, short-term trading is taxed at a different tax rate than if you were to hold it for a long-term duration of 1 year or more. So for this example, let's specifically look at this tax bracket of 89,000 to 190,000. So we'll be looking at any of the capital gains that fall into this bracket. So a short-term trader would be taxed at 22%, and a long-term holder would be taxed at 15% when they. So let's look at a basic scenario. This person invests $1,000 initially, and then they're contributing an extra 500 bucks every single month. They're holding it for 40 years, so think of this as holding until retirement. We'll look at 11% to align with the S&P 500. So after 40 years, you have put in a total of $241,000, but your account has grown to a little over $3.5 million. So incredible returns. Now, as a long-term investor, you would then, at the end of it, when you sell, incur a 15% tax. So in total, of that $3.5 million portfolio, you would pay about $500,000 in taxes, and you would still have a little over $3 million. Amazing. Now, if you were a short-term trader, so someone who was trading every single year, and first, remember, most of the people who even do this on a yearly basis, day trading, are losing money. But hypothetically, let's say if they could get the same amount of returns as the S&P 500 every single year for 40 years, which is highly unlikely, but for the scenario, let's go ahead and say they did it. Over a 40-year time horizon of having an annual return of 11%, but every year they're having to pay 22% tax on the gains they made. So every year they're having to pull out money to pay those taxes. And at the end of 40 years, they would have paid almost $550,000 in taxes. So more taxes paid over this time frame than the long-term investor. And the remaining balance is about $1 million less, all because they were day trading or swing trading or making trades at 1 year or less and incurring that higher tax rate, as well as having to pay taxes every single year instead of waiting until the end. They were directly working against compounding. They weren't allowing it to work in their favor. And if someone's out there with a huge ego and they're saying, well, 11%, I'll do way more than that. Give me at least 12, 13, 14%. Again, over a 40-year time period, highly doubtful. But even if they can do that, all right, well, why? you still have to beat then the Nasdaq 100, which does 14 to 16%. If we looked at this chart, the Nasdaq 100 would have returned a little over $8 million. So hopefully at this point, you're kind of getting a little bit the ideal that if you want to have success in the investing game long term and build real wealth, you realistically should stay focused on the long term and avoid all the short term noise. So, with that, let's go ahead and dive into some long term investing tips so you can learn how you can become a great long term investor. So, for my 10 core investing principles, the first one is critical. So, a long-term investor, you're still going to see the short-term noise that's hitting the market, and you have to avoid letting that impact you and influence your investment decisions. You can't let the short-term noise make you start panic selling to try to avoid losing temporary money. And you also can't allow it to cause you to FOMO buy into a stock that's already rode up 100%, 200%. If it's already gone up that much, you've likely already missed it. You really need to do the research on the companies to understand the future opportunities before the big runs happen. And if we look at this chart that looks at the psychology of market cycles, you can see without fail, the market will always go through cycles like this. You know, this run will start going up, people will start getting optimistic, and eventually at the peak, they'll have max euphoria of, man, this is amazing. I'm making so much money. This is easy. Then the fall starts to happen. They get complacent thinking like, yeah, it's gonna bounce back. Then anxiety hits them. Then they start denying. And then it starts really falling and they start panicking and they end up selling, just saying, I need to get out before this all gets lost. And then they get really angry that I had all this money, the market's rigged, I'm getting out, like this is pointless. And then the cycle starts to repeat. And as a long term investor, you can't let these cycles scare you out of the market or end up chasing overvalued companies that are rising faster than they should. If we focus on these periods down at the bottom here, when people are the most angry, the most bearish, and the most disconnected from the markets, these are the times we want to be doubling down because once that next market cycle starts, this is when we're going to have increased gains that we wouldn't have had before. Next, always zoom out. So the short-term noise is always going to happen. Your portfolio might swing 20, 30% when the market gets bad. And you might be thinking, man, should I just reduce some risk here? At the end of the day, you always want to zoom out because if we look past the last 125 years, you can see these global events. There was wars, there was pandemics, there was economic crisis happen. And all of these are now just little blips on the radar. These were catastrophic events at the time, but now years later, all they were buying opportunities and blips on the radar. Even the biggest one back here, the Great Depression, that one you can still see, but even at the peak, what was the Dow out here? 320. The Dow's over 50,000 now. So that just shows how much it's ran since then. The next four are really focused on understanding the business fundamentals, understanding what you're investing in, and projecting out what the future returns could be. And the reason we do this is so we can be confident when those market turmoil events happen, so we can buy the dip and ensure that we get those outsized returns going in the future. And then once we're doing this and things are flowing, we've got our process down, we have to trust our process. Don't let short-term things skew you from what you know is right. And then as the years go on, you'll start seeing the compounding work for you. Don't interrupt that. Let it continue to work for you and ultimately enjoy the ride because as the years go on, you'll really start seeing that the compounding of the stocks you bought 5, 10 years ago is starting to make more money than you can even contribute. So, lastly, let's wrap up with some words of wisdom. So, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. What this means is in the short run, emotions, news headlines, fear, greed, general sentiment can really impact what happens, similar to like a voting machine or election happens. But in the long run, it performs like a weighing machine. It doesn't matter what the hype or emotions or what the daily chatter is. All that matters is the cold, hard facts and the fundamentals of the business that you're invested in. So that's all I got for this one. Remember, at the end of the day, if you're trying to build real long lasting wealth via investing, you need to just stay focused on the long term. Don't let all the hype and emotions of different short term news articles or the poll of someone who just made multiple 100% by doing some risky day trade. Don't let that pull you into to the dark side. Stay on the good side. At the end of the day, let the compounding work for you. Understand what you're invested in and enjoy the ride. That's all I got for this one. If you liked this content, hit that like button down below, hit that subscribe button, and stay tuned for future videos. I hope you have a great rest of your Monday and enjoy the day off from the stock market. Let's get back at it tomorrow. Peace.